Most traders don't have a strategy problem. They have an entry problem. And that's uncomfortable to admit, isn't it? Because it means the issue isn't the market, it's your timing, your decisions, the exact moment you choose to act. Let me ask you something. How often have you taken a trade that looked perfect, only to watch it move against you almost immediately? And how often did it later go exactly where you originally expected? That's not bad analysis. That's bad entry. You see, the market doesn't punish ideas. It punishes impatience. Most traders enter because they believe something will happen. Not because the market has proven it's happening. That small difference, that gap between belief and confirmation, that's where your losses live. But here's where it gets interesting. Why do you rush in early? Is it because you want a better price? Or because you're afraid of missing the move? Be honest, because those two motivations look similar on the surface, but they produce completely different results. Let's break this down. When you enter early, you're trying to anticipate the market. You're saying, I know what's about to happen. And sometimes you're right. But the market doesn't reward being early. It rewards being aligned. There's a cost to anticipation. It's called uncertainty. And uncertainty shows up as drawdown. So when you enter too soon, you're not just risking money. You're increasing emotional pressure. And once pressure builds, your decision-making deteriorates. Have you noticed that? One bad entry leads to hesitation. Hesitation leads to missed exits. Missed exits lead to bigger losses. And suddenly, what started as a small mistake becomes a cascade, all from the entry. Now here's the part most traders overlook. A good entry doesn't feel exciting. In fact, it often feels late. Strange, isn't it? Because by the time the market confirms your idea, a portion of the move is already gone. And your instinct says, you missed it. But what if that instinct is exactly what's hurting you? What if the safest trades are the ones that feel slightly uncomfortable? Not because they're risky, but because they go against your need to be early. Think about this. If a move is real, it won't disappear in a few seconds. Real momentum leaves footprints. Structure forms. Levels break and hold. Participants reveal themselves. So why are you so eager to jump in before any of that happens? Is it confidence, or is it anxiety dressed up as confidence? Here's the shift that will fix your entries. Stop trying to catch the move. Start trying to join the move. There's a difference. Catching requires prediction. Joining requires observation. Prediction puts pressure on you. Observation puts pressure on the market. And that's where you want it. Let's make this practical. Before entering any trade, ask yourself, what has the market proven so far? Not what you think, not what you hope. What has actually happened? Has price broken a key level and held above it? Has it shown continuation after a pullback? Has it rejected an area multiple times? Or are you entering because looks ready? That phrase, it looks ready, has cost traders more money than bad strategies ever have, because looking ready is not evidence. Now here's another layer. Your entry is not just about price. It's about context. Where are you in the larger structure? Are you buying into resistance because you're afraid of missing out? Are you shorting into support because you want to catch the top? Let me ask you, why do traders love tops and bottoms so much? Because they promise maximum reward, but they also come with maximum uncertainty, and uncertainty is expensive. The best entries don't happen at extremes. They happen after confirmation, after the market shows its hand, after other traders are already committed. Yes, you'll miss the very beginning, but you'll gain something far more valuable, clarity, and clarity reduces mistakes. But here's where most people get stuck. They know they should wait, but they don't. Because waiting feels like doing nothing, and doing nothing feels like missing opportunities. So they trade to feel productive. Let me ask you, are you trading to make money or to feel involved? Because those are not the same thing. Discipline in entries is not about forcing yourself to wait. It's about redefining what a valid opportunity looks like. If your criteria are vague, your entries will be emotional. If your criteria are clear, your entries become mechanical. So what are your actual conditions for entering a trade? Can you describe them without hesitation? Or do they change depending on how you feel in the moment? Here's something worth thinking about. Every bad entry leaves a psychological scar. You become more cautious, more reactive, less trusting of your own judgment. And over time, this erodes your confidence. Not because you're incapable, but because your process is inconsistent. Fix the entry, and you stabilize the entire system. Now consider the opposite. When you wait for confirmation, when you enter based on evidence, something changes. Even if the trade loses, it feels different. Why? Because you followed a process, and process builds confidence. Confidence builds patience. Patience improves timing, and better timing leads to better outcomes. It's all connected. So the question becomes, are you willing to sacrifice the illusion of perfect entries for the consistency of high-quality ones? Because you can't have both. You can't demand precision and ignore confirmation. You can't avoid drawdown if you insist on being first. Watch the market more than you trade it. Let it move. Let it reveal itself. Let other traders commit before you do. And when you finally enter, it shouldn't feel like a guess. It should feel like a response. A reaction to something that has already happened, not something you hope will happen. And if you start doing this consistently, something subtle begins to shift. Your trades become calmer. Your decisions become quieter. You stop chasing. You stop forcing. And without realizing it, you begin to see the market less as something to conquer and more as something to read. Entering without confirmation is choosing emotion over evidence. Most traders don't realize this when they click the button. It doesn't feel emotional. It feels logical, even smart. The setup looks clean, the level is obvious, the idea makes sense. But underneath that sense of clarity, there's often something else driving the decision. Urgency. Have you ever felt that quiet pressure that says, get in now or you'll miss it? That's not analysis. That's fear shaping your timing. Because if it were truly based on evidence, you wouldn't need to rush. Evidence doesn't disappear in seconds. It builds. It unfolds. It confirms itself step by step. But emotion doesn't wait for that process. Emotion wants certainty before it exists. So you enter early. And when you enter early, you're not trading what the market has done. You're trading what you hope it will do. That's a dangerous position to be in. Because hope has no structure. It doesn't respect levels, it doesn't follow momentum, and it certainly doesn't manage risk. It simply pushes you into trades before the market has committed. And then what happens? The market hesitates. It pulls back. It moves sideways. And suddenly, your perfect setup starts feeling uncomfortable. Now you're in a position where you have to endure uncertainty that could have been avoided entirely. If you had waited. But waiting feels passive, doesn't it? It feels like you're letting opportunities slip away. It feels like other traders are getting ahead of you. But ask yourself this, are they really ahead, or are they just earlier? Because being early and being right are not the same thing. In fact, being early often means being wrong first, and that initial drawdown, that immediate move against you, starts affecting your judgment. You begin questioning your idea, adjusting your plan, maybe even exiting too soon. Not because the trade was invalid, but because your entry was premature. This is how emotion quietly sabotages good analysis. You didn't need a better strategy. You needed better timing. And better timing comes from requiring proof. What does proof look like? It's the market breaking a level and holding above it. It's a pullback that finds support instead of collapsing. It's continuation that shows real participation, not just a brief spike. These are not guesses. These are signals. But here's the part that challenges most traders. By the time you get that confirmation, the trade no longer looks perfect. The price is higher, the move has started, and your instinct tells you that you're late. So you hesitate, or worse, you ignore the confirmation entirely and go back to anticipating the next setup, repeating the same cycle. Why? Because emotionally, you're still attached to the idea of getting in at the best possible price. But the best price is not the one that comes first. It's the one that comes with the least uncertainty, and that only comes after the market shows its hand. Think about it this way. If you need the market to move in your favor immediately after entry to feel comfortable, then your entry is too early. A strong entry doesn't require instant validation. It's built on validation that already exists. So instead of asking, where can I get in cheapest? Start asking, where is the market proving me right? That shift changes everything, because now you're no longer trying to predict the move, you're responding to it. And when you respond instead of predict, your decisions become calmer, more grounded, less reactive. You stop forcing trades. You stop justifying entries. You stop confusing potential with confirmation. And over time, you begin to notice something subtle but powerful. The trades you used to rush into, the ones that felt urgent and necessary, they were never as strong as they seemed. The market rewards alignment, not anticipation. Most traders step into the market thinking their job is to predict what comes next. They study patterns, draw levels, build scenarios, and then try to enter before the move begins. It feels proactive. It feels intelligent. But it places you in a position where you're constantly trying to be ahead of something that hasn't happened yet. Let me ask you, how often does the market actually respect your timing when you do that? Because anticipation is built on expectation. You're forming an idea and then trying to act on it before the market confirms it. And when you do that, you're no longer aligned with price. You're ahead of it. Being ahead sounds like an advantage, but in trading it usually means you're exposed. Exposed to what? Uncertainty. When you anticipate, you're entering during the phase where the market hasn't decided yet. Structure is still forming. Buyers and sellers are still competing. Direction is not established, and you're placing your capital right in the middle of that conflict. That's why so many trades go into drawdown immediately after entry. It's not because your idea is wrong. It's because your timing is disconnected from what the market has actually confirmed. Now compare that to alignment. Alignment doesn't require you to be first. It requires you to be in sync. You wait for the market to show direction. You observe how it behaves around key areas. You watch how price reacts. Does it reject? Does it break? Does it continue? And then you act. Not before, after. Does that feel slower? Of course it does. But slower is not the same as worse. In fact, slower often means more precise. Because when you align with the market, you're no longer guessing. You're responding to something that has already started to unfold. You're stepping into momentum instead of trying to create it in your mind. Think about how different that feels. When you anticipate, every tick matters. You watch price closely, hoping it moves in your favor. Small pullbacks feel threatening. You question your entry almost immediately. But when you're aligned, there's a level of acceptance. You've seen the move begin. You've seen confirmation. So you're not depending on the next candle to validate you. The market has already done that to some degree. That difference changes your behavior. You become less reactive, less emotional, more patient. But here's where traders struggle. Alignment often looks like you're late. Price has already moved. The breakout has happened. The trend is visible, and your instinct says you missed it. So you hesitate, or worse, you go back to anticipating the next move just to feel early again. Why is being early so important to you? Is it really about price, or is it about feeling in control? Because anticipation gives you the illusion of control. It makes you feel like you're ahead of the crowd, like you see something others don't. But the market doesn't reward that feeling. It rewards participation in moves that are already proving themselves. Alignment is not about catching the exact bottom or top. It's about entering where probability has shifted in your favor, and probability only shifts after the market reveals intent. That's the part many traders ignore. They want the reward of alignment without the patience it requires. They want confirmation, but they don't want to wait for it. So they operate in between, not fully anticipating, not fully aligned. And that middle ground creates inconsistency. Sometimes it works, sometimes it doesn't. And over time, it becomes difficult to trust your own decisions, because your process isn't stable. So ask yourself this: what would happen if you stopped trying to predict and started trying to follow? What if your goal wasn't to be first, but to be positioned with the move once it shows itself? That shift removes a lot of pressure. You're no longer responsible for calling the market. You're responsible for recognizing it, and recognition is a skill you can refine. You begin to notice how real moves behave differently from fake ones, how strong trends don't hesitate at key levels, how pullbacks in healthy moves are controlled, not chaotic. These are not things you can anticipate clearly. They are things you observe as they happen. And once you train yourself to look for those signs, your entries start to change. They become less about timing the exact turning point and more about joining something that is already underway. If your entry feels urgent, it's probably driven by fear, not logic. Urgency has a very specific feeling. It tightens your focus. It speeds up your thinking. It pushes you toward action before you've fully processed what's happening. And in trading, that feeling is rarely a signal. It's a reaction. Have you ever noticed how quickly your standards drop when you feel that rush? A setup that needed confirmation suddenly looks good enough. A level you weren't planning to trade becomes close enough. You stop asking questions, and instead you start justifying. Why? Because urgency doesn't want clarity. It wants participation. It tells you that if you don't act now, you'll miss something important. A move, an opportunity, a profit that feels like it's slipping away in real time. But let's slow that down for a moment. What exactly are you afraid of missing? Is it the trade itself, or the feeling of being left out? Because those are not the same thing. When a trader operates from logic, the process is structured. There are conditions. There's patience. There's a willingness to wait for the market to meet specific criteria. But when fear enters the picture, structure dissolves. You start bending your rules. You start entering earlier than planned. You start seeing setups where there aren't any. And the most dangerous part is, it all feels justified in the moment. That's what makes urgency so deceptive. It doesn't feel like fear. It feels like conviction. But conviction without evidence is just emotion with confidence. And the market doesn't reward that. Think about the timing of your worst trades. Were they calm decisions? Or were they rushed? Did you feel in control, or did you feel like you needed to act before it was too late? Because urgency often shows up right before a mistake. Not always, but often enough to matter. And here's why. When you rush into a trade, you're entering before the market has given you full information. You're stepping in during incomplete conditions. That means your risk is based on assumption, not confirmation. An assumption is fragile. The moment price does something unexpected, and it will, you're caught off guard. Your confidence drops. Your plan becomes unclear, and now you're reacting instead of executing. All because the entry was driven by urgency. Now compare that to a trade taken without pressure. There's no rush, no internal noise. You've seen what you needed to see. The setup meets your criteria. The market has already shown signs of direction. So when you enter, it feels simple, not exciting, not intense. Just clear. That's what logic feels like in trading. Quiet, not loud. But most traders are not used to that feeling. They associate good trades with strong emotions, excitement, anticipation, even adrenaline. So when a trade feels calm, they hesitate. And when a trade feels urgent, they act. Do you see the reversal? The very feeling that should make you pause is the one pushing you forward. And the feeling that should give you confidence is the one you question. This is where awareness becomes critical. You don't need to eliminate emotion. You need to recognize when it's influencing your timing. The moment you feel urgency, that's your signal. Not to enter, but to step back. Ask yourself, what has the market actually confirmed? Not what it looks like. Not what it might do. What has it done? If you can't answer that clearly, then the urgency is not coming from the market. It's coming from you. And that distinction matters. Because trade should be based on external evidence, not internal pressure. Here's something to consider. If a move is strong and real, it will provide multiple opportunities. It won't vanish in a single moment. It will pull back, consolidate, continue. It will give structure. But urgency makes you believe that this is your only chance. That's how fear compresses time. It turns a series of opportunities into a single fleeting moment. And once you believe that, you lose patience. You stop waiting for quality. You start chasing participation. So the next time you feel that impulse, that need to get in quickly, don't treat it as a green light. Treat it as information. Something inside you is reacting. A good trade should make sense after the market moves, not before. That idea sounds backwards at first. Most traders believe their job is to fully understand the trade before they enter it. They want clarity up front. They want to feel certain. So they analyze, anticipate, and build a narrative about what the market is about to do. But let me ask you, how often does that pre-trade clarity actually hold up once the market starts moving? Because the truth is, the market doesn't reward how convincing your idea feels before entry. It rewards whether your idea aligns with what actually unfolds, and that alignment can only be judged after the move begins. Think about it. Before the move, everything is potential. Multiple outcomes are possible. Price can break up, reject, consolidate, or reverse. And in that moment, you're choosing one outcome and acting as if it's more likely than the others, without proof. That's where most entries go wrong. They're built on a story that hasn't been validated yet. It feels logical. It feels structured. But it's still a projection. And projections are fragile, because the moment the market behaves differently than expected, your entire reasoning starts to crack. You hesitate. You question. You adjust. Not because you lack skill, but because your entry was based on something that hadn't been confirmed. Now flip that perspective. Instead of asking, does this trade make sense right now? Ask, will this trade still make sense if the market starts moving? That's a different standard. Because now you're not just evaluating the setup, you're evaluating how it behaves under pressure. A strong trade doesn't need immediate defense. It doesn't require you to explain every tick. It becomes clearer as it develops. The movement itself reinforces the idea. So when the market moves in your direction, you're not surprised, you're aligned. But when you enter too early, you need the market to cooperate instantly just to validate your decision. And if it doesn't, doubt creeps in. Have you noticed how quickly confidence disappears when a trade goes slightly against you right after entry? That's not just about loss. That's about uncertainty. Because deep down, you know the market hasn't confirmed your idea yet. You're waiting for validation that should have come before you entered. That's the shift. Validation first, entry second. Not the other way around. Let the market begin the move. Let it show intent. Let it commit in one direction with enough clarity that your idea is no longer just a possibility. It's becoming a reality. Yes, you'll enter at a worse price, but you'll enter with better information. And better information reduces unnecessary risk. Now here's where it gets subtle. A trade that makes sense after the move doesn't mean chasing blindly. It means entering at a point where the structure supports continuation, where the behavior of price confirms strength, not just hints at it. So what does that look like? It looks like a breakout that holds, not one that immediately fails. It looks like a pullback that finds support, not one that collapses through it. It looks like momentum that builds, not fades. These are signs you can observe, not predict. And once you begin focusing on those signs, your entries start to change. They become less about timing the exact turning point and more about participating in a move that is already proving itself. That shift removes a lot of internal pressure. You're no longer trying to be right immediately. You're allowing the market to demonstrate that you're right over time. And that changes how you manage the trade as well. You become less reactive to small fluctuations, less tempted to exit prematurely, more willing to let the trade develop. Because your confidence isn't coming from your prediction. It's coming from what the market is actively doing. So instead of needing the trade to make sense before you enter, you allow it to make sense as it unfolds. That's a more stable foundation, because it's built on evidence, not expectation. And when you start operating from that mindset, you begin to notice that the trades you take feel different. Less forced, less rushed, more grounded. Chasing perfect prices often leads to imperfect decisions. There's a quiet obsession many traders carry, the need to get in at the exact level, the lowest buy, the highest sell, the cleanest possible entry that leaves no room for drawdown. It sounds disciplined, doesn't it? But look closer. How much of your decision-making is shaped by that need? Have you ever skipped a valid setup just because price moved slightly without you, or entered too early just to secure a better price before confirmation? That's not precision, that's pressure. Because when you focus on perfect pricing, your attention shifts away from what actually matters, the quality of the trade, and towards something you can't control. The market doesn't care about your ideal entry. It doesn't pause at your level just because it looks clean on your chart. So when you try to force that precision, you start making compromises. You enter before confirmation. You ignore structure. You justify trades that aren't fully developed yet, all for the sake of a few extra points. And here's the cost. You gain a slightly better price, but you take on significantly more uncertainty. Is that really a good trade? Because a strong entry is not defined by how cheap or expensive it is. It's defined by how much the market has already confirmed your idea, and confirmation rarely happens at the exact turning point. That's the uncomfortable truth. The cleanest levels, the ones everyone sees, are often where uncertainty is highest. Price is reacting, not committing. Buyers and sellers are both active. Direction is not clear yet, but that's exactly where traders try to get in. Why? Because it feels efficient, because it promises maximum reward, because it looks like control, but in reality, it places you in the most fragile part of the move. Think about your past trades. How many times did you enter at a perfect level, only to watch price break through it, stop you out, and then move in your original direction? That's not bad analysis. That's premature execution. You were right about the move. You were wrong about the timing. And that timing was influenced by your desire to get the best price. Now consider the alternative. You wait. You let the level break. You let the market show strength. You allow some distance to form between the turning point and your entry. At first, it feels like you're giving something up. Price is no longer perfect. The move has already started. It feels like you're late. But what have you actually gained? Clarity. Because now the market has revealed intent. It's no longer reacting. It's moving. And that movement carries information. Information you didn't have at the perfect level. So your entry, while less precise in price, becomes more precise in context. And context is what keeps you in trades, not price. A perfect entry with weak context will shake you out quickly. A slightly worse entry with strong context will hold. That's the difference most traders miss. They optimize for entry price instead of entry quality. And those are not the same thing. Let me ask you, what matters more? Saving a few points on entry or increasing the probability that your trade works? Because you can't maximize both at the same time. There's always a trade-off. And when you chase perfect prices, you're choosing price over probability. Now here's where it becomes a pattern. Once you start focusing on perfect entries, you become more reactive. You watch the market closely, waiting for it to reach your level. And when it gets close, your urgency increases. You don't want to miss it. So you enter quickly, sometimes too quickly, before confirmation, before structure, before clarity. And just like that, your decision is no longer based on what the market is doing. It's based on what you want from the market. That's where mistakes begin. Because the market doesn't reward desire, it rewards alignment. And alignment doesn't require perfection. It requires patience. So instead of asking, is this the best price I can get? Start asking, is this the best moment to enter based on what the market has shown? That question shifts your focus, from control to observation, from precision to probability. And over time, you'll notice that the trades you take become more stable, less dependent on immediate movement, less vulnerable to small fluctuations. Waiting is not missing out, it's filtering low-quality opportunities. Most traders don't see it that way. To them, waiting feels like inactivity, like time wasted, like watching the market move without them while others are making money. And that feeling creates pressure, the kind that pushes you to act just so you don't feel left behind. But let me ask you something. Are you actually missing opportunities, or are you just avoiding the discomfort of not being in a trade? Because those are very different things. The market is constantly moving. There are always setups forming, always price reacting, always something happening. If your definition of opportunity is simply movement, then yes, you're missing out all the time. But not all movement is tradable.